Hi there, everyone. Rob McGregor here, and welcome to our latest edition of OnTrack. It's the 30th of January in the middle of the day as I'm recording this. Happy New Year to everyone. We've got all our numbers up to date to the end of December and all the latest what's going in the market right up to date, including lots that's going on at the moment. Hope everyone had a great Christmas and a great new year. I certainly did. Had 3 weeks in New Zealand, which was extremely nice, and enjoyed the time over there. Good to be back though. And this certainly 2023 is going to be an interesting year. For those that, so firstly, just our general advice warning. This presentation, this monthly recording, this monthly podcast is designed for clients of McGregor Wealth Management, and particularly those that use our care investment methodology and process. For everyone else, feel free to listen, but please do seek out advice before acting on anything you might hear in here. I'm going to cover what's happening in the economy, some of the news, put into context around what it means for your portfolios, talk about where the key markets are, what's happening in there, talk about the returns that we're seeing, what to expect, sorry, the typo there, what to expect in 2023, what's happening in the property and share markets, and put it all in perspective. I got a quote from a guy called Howard Marks. Howard Marks is one of these wise elders of the investment world. He's been managing money very successfully for 50 years. He's approaching 80, I think. He's been writing an investment memo to his clients for the best part of 30 years. I've read them all. If anyone ever wanted a quick lesson in investing, sorry, not a quick lesson, a very good lesson in investing, you can read them all. It's very, very wise. And one of his quotes here that I love is that, the 3 stages of a bull market. The first stage, when only a few unusually perceptive people believe things will get better. The second stage, when most investors realize that improvement is actually taking place. And the third stage, when everyone concludes things will get better forever. I'm not suggesting we're at the start of a bull market, but I'm not ruling it out either. And in that stage, the first stage, he talks about not many people actually think we're in that, and that's certainly prescriptive of the moment. Let's have a look at some of the news and numbers. And we saw share markets. December was a pretty ordinary month. We're down anywhere from 4 to 7%, depending on the markets, but we're up that and then some in January. So you can see the chart down the bottom corner, massive volatility over the last year, but we're ending the year, well, certainly ending the 12 months right now on a high note. So January's taken off well, and I'll talk about some of those levels. I expect we're going to see volatility like we have. If you look from May through June, July, August, all those, we've seen ups and downs quite steadily. It's all been about what's happening with inflation and interest rates. So when we think we're on top of inflation, markets tend to go off for a little bit. If any news or numbers come out that show we're not, then that tends to bring markets back down. And I'll talk more about where we're up sharp with that. You can see on the side, I'll come back to some of this news in a minute, the RBA cash rate still at 3.1%. When they meet on the 7th of February, they'll decide whether to put that up. You'll see another chart here, the RBA rate tracker. So this shows where markets think this is happening and what's happened to that even during January. So when we were on the 17th of January, the market, and this is built into futures prior, but 61% of the market was effectively assuming we were going up to 3.35. So up by 0.25%, and 39% were saying no change. And just in the next 10 days, the amount of people thinking no change has actually dropped. So the market consensus is now 3.35. I still think it's a bit 50-50. What the RBA is facing is just trying to get these interest rate rises just right. Very hard to do. And I'm going to talk a bit about, when we talk about, there's a fixed rate cliff coming up where all the people at fixed rates around about 2% a year or so ago are coming up for renewal in the next 1 to 3 years. And that's going to cause them to jump from paying 2-ish% to more like 5 or 6s, and what that does for the economy. So the RBA is keeping one eye on that, but also they're keeping one eye on inflation. I'll talk about those numbers. Bank bill rate up a little bit. That's 90 days. It's like a 3-month term deposit. 10-year government bond yields actually pretty stable. You'll see across the last 3 months now. There's been a bit of fluctuation around that, and I'll show you some of those numbers in a minute. The Aussie dollars strengthened a bit more, up to 71 cents. As you'll recall, we locked in some of our overseas investments at an Aussie dollar of about 62 cents. That's looking very good at the moment. We're happy to hold that trade at the moment. The Aussie inflation didn't back off, while US inflation backed off. You'll see the next number. US inflation dropped from 7.1 to 6.5. Aussie inflation still spat out 7.8. There's lots of lags in this whole process. So the market is reading beneath the lines here. And the market, you can tell when the share market's running like it is at the moment, that the majority of the market is thinking, we've beaten inflation. And when I say we've beaten it, we haven't beaten it yet, but we can see the end of it coming. So they're starting to, relax a bit, assume that shares are a good investment. But we're kind of seeing it in some numbers, but not at the others. And I think as the numbers continue to come out, we're going to see this back and forward, good news, bad news. And I'll talk about this a few times today. Mortgage rates haven't changed now for a couple of months. But obviously on the 7th of Feb, if rates go up, they'll go up. If rates stay the same, they should stay the same. And one-year term deposits, we're seeing plenty of 4s at the moment. Macquarie at 4 there, but we're seeing some others at slightly more than 4 for those that want to go shopping and those that have cash temporarily. On the international stage, China, a big change during January. It's very positive for the world as China relaxing their lockdown policies. That's going to reduce some of the supply chain blockages where it was taking longer to get goods around the world, which include everything from car parts to computer chips to all sorts of things that was slowing down the world economy. So China's back in business. And there were some positive comments from China at Davos, at the World Economic Forum, that we think are positive, but I put the proviso maybe there. I'll talk about that in a minute. Australian residential property is still pretty cool. It's not surprising given where interest rates are at. So anyone borrowing at the moment is looking at being assessed at more like about 8%. So 5 or 6% where the rates are, plus a 2 to 3% margin by the bank. And they're doing this themselves as well. So that's slowing down buyers. Although there's still a good market, but I'll update you on where those markets are at during this. And the flip side of that, as I've said here, is that while interest rates are affecting pricing, there's a floor under property prices, mainly due to a couple of things, but really strong rents. So for investors, properties returning a good rental years, and they've gone up 10% in the last 12 months. Strong immigration. I'm going to talk about where immigration is looking like for the next year, but it's going to be above what everyone thought. So it's going to mean more people needing homes, and strong employment. And that means while people are in jobs, they can pay mortgages that are going up. We're seeing, even though there's shortages in many industries, we're seeing responses come from those that were partly employed. We're seeing some semi-retired or retirees return to the workforce, mums or parents coming back in the workforce. So the workforce has responded without wages going up, which is a good sign at the moment, and hopefully that continues. So this was the news out of Davos, and there's a economic forum there where all the economic gurus get up and talk, but lots of the world leaders come to this as well. And China was making soothing noises here, saying we're open for business after a few years where they were picking fights with everyone around the world over trade and other things. They've sort of said they want to do business. Now, a cynic might say, why are they saying that? And partly, there's down at the bottom of this article, there's two reasons, partly for this, besides, but one of the main reasons is China's population is starting to peak. So, it's likely that they're hitting their peak of population, just like Japan did a while back. And short of immigration, which is not a natural policy of China, they're not going to see a lot of population growth, and their GDP growth has slowed. So once upon a time, and you see the charts I've added, these were in the article, but on the right, top right, China's growth rate going back to the 90s was always 5–10%. But you've got to put this in context. China's GDP per capita, which is roughly means the income per head of a country, right now is just under 12,000 US per person. And to put that into context, US about 63,000, Australia 59,000, Japan 35,000, Germany 51,000. They're all US dollars. So China's a long way from having their people being on the same levels of income as what we would call first world nations. So they've got lots of people. They need to increasing that. And the challenge with slowing growth for them is if that slows down, then that's going to keep their people unhappy. They've got billions of people. They need their standard of living growing. And to do that, they need to be playing friendly with the world. That's the positive side. The cynical side will say, well, they're just trying to play nice so they can keep building and have another silent war. China will show up on the risk issues when I go through. At the moment, though, part of our run in January is because, for now, China's playing nice. Looks like they want to play. We'll see what that translates for Australia, but generally China growing is very, very good for Australia and for our commodities, as long as they're happy to buy them from us. And it looks like they're more inclined to that, both with their current new environment, and also they seem to be getting along a bit better with our government at the moment compared to a couple of years ago. Returns for the month of December, negative. So a high growth portfolio down about 2.7%. International shares were the worst of that. This is almost old news though, because as I said, the markets are up more than that in January. So we're now hitting highs. And as always, these portfolios continue over the long run to display the types of returns that we would expect exactly for their nature. With the dial, our market view is right up to the minute. So it's not December 31, it's right now. We've got that just a little bit above fair value, not a lot, but just to recognize that the market's had a bit of a run. There remains plenty of room for volatility. And I'll just qualify, the way we use this dial is not for any trading activity. It would be quite dangerous to trade based on this. But for new money coming into the market, it means we'll just put it in a bit slower. And where people are needing money in the next few years, it just means it's a good time to be rebalancing or pulling money out if there's upcoming holidays to be paid for or cars to be purchased. So it's what we call money on the move, not for trading, not for taking any positions, but for just maneuvering to make sure we've always got enough ready for the spending in life. My behavioral bias of the month, and I've probably done this one before, but you can never understand these too much because they are the most important factor when it comes to long-term investing success, is avoiding the mistakes that come from all these. So this one for this month is called loss aversion. And it's the fact that losses are perceived by individuals as far more emotionally severe than the equivalent gain. So someone's more scared of losing $100 than they are of gaining the same amount. And there's been numerous studies done over the year. And it's partly because we're, the nature of humans, we're wired for fear. In our primitive days, fear kept us alive. If we heard something rustling in the grass, it could have been a predator, so we had to run. In a modern world, that fear bias does not serve us well, and particularly investing, it serves us really badly. Down the bottom here, it explains that loss psychology may even be the cause of what we call asymmetric volatility, and that is the fact that markets tend to go up slowly. As someone once put it, they go up via the stairs, but they come down the elevator. They can come down quite quickly. And that's because when we get scared of things, everyone gets scared together, and markets can come down very quickly. So part of our goal with investors is to make sure they're not overly fearful, because that is a big enemy of success. This chart is describing better and better all the time a typical cycle. Now, it's not the way around, but we saw this boom in the 2000s and driven in Australia even more by the commodities boom. That's our boom of FOMO, fear of missing out, as we call it, followed by a bust, which there's always an overreaction when we get it. Then we get a bounce back from that overreaction. But then, since 2009, since 2010, we've pretty much been in what we would call the wall of worry. So this is where the market sits for probably 70 to 80% of the cycle, where we grind uphill, but we're always having these dips where we're worried about something. Then we recover from that worry, and then we grind up a bit more, and then we drop through worrying about something else. We've seen this one close, the one we're in at the moment. Back a couple of months, we were down 15%. Right now, we're almost back to closing that dip as the fear of inflation slowly comes out. But that's what that was about. And generally with all of these, by the time we pass through it, we've long since, we treat it very seriously at the time, but you look back at some of these. So back in 2011, there was fears we were going to have another meltdown like the GFC. Then there was fear of European crisis, mainly led by the Greek crisis. 2016, we had fear of slow growth and falling oil prices. It's funny how we were worried about falling oil prices, then we can be worried about rising oil prices. But this cycle will continue, but eventually, and this goes to the quote at the start of today's episode, eventually we've started a bull market, no one knows it. And if you go back to this one, and we can't see the start of it here, but eventually we stopped having these big breaks all the time. It kept going. Then everyone says, wow, we're really in good economic times right now. Let's all invest in shares. And then eventually at the top, where it goes up dramatically, and you can see the dramatic increase from 2005 through 2007, where the market market doubled from mid 2005 to 2007. 2.5 to 3 years doubling, always a warning, or potential warning. And then over it went. So we're nowhere near that at the moment. Hopefully we're at the start of that, but we won't know for many years. But at the moment we are firmly in the wall of worry. Interest rates, we've all become a bit more obsessed with interest rates because all of a sudden we've gone from not much to having some. It's particularly affected mortgage holders. But this is a chart I've shown in the last, for the last little while. It's the yield curve. So the Australian yield curve top left. So the blue line is the yield curve as at the 20th of January. So as you look across the bottom of the chart, it shows what rates you would get for investing in bonds of any yield. So a 10-year bond, around about 3.5% in Australia right now, around about the same in the US. You get a little bit more, up to 4% for really long-term bonds. Not that they're very popular in Australia. And that yield curve, the green dots show where it was 1 month ago. So interest rates have dropped across the board in the last month. That is part of why shares have gone up. Generally, weaker interest rates means stronger share prices. Excuse me, and stronger interest rates can mean weaker share prices. In the short term, other factors come into play. You can see at the bottom of this table, you can see interest rates over the last 20 years. So we've come from high interest rates, dropping, to where we had the emergency interest rates of 1%. It's quite obvious now these were emergency interest rates to get us through COVID. And we're now emerging back to where we were sort of 2010-ish. And now the question is, are we steadying? Are we going to drop? Are we going to go up? We sort of have a belief that we're probably starting to fall into a range of 3 to 4%, maybe 3 to 4.5% that the world might cycle through. We don't say that with any great confidence because these things are affected by so many things. But for now, that's where our view is. So we think we're seeing a bit of steadiness there, which is a good thing. Stability in interest rates will be a driver of good share market performance. The news cycles, and I'm repeating this again because we're going to see continued good news, bad news. And the good news, bad news isn't always obvious because sometimes you'll see an announcement like the one we saw on Friday, inflation in Australia at 7.8%. If you go back and look at the share market that day, it didn't move the market at all because it was expected. It was known news. We know it's going to drop, but we weren't expecting it to drop this quickly. And we'll see that goes down. The news that causes markets to drop is either news that's unexpected, like a big surprise, or it's worse than we originally thought. If news is less bad, it's actually good. But if news is bad grammar warning, if news is more bad, that's when it's really bad. So if all of a sudden we're expecting an inflation number that was falling, but it actually jumped a lot, that would cause markets to react. So the hot topics that we can see panning out for 2023, inflation, how long will it run for? Interest rates, how high? Russia, Ukraine, how long? Good one to pause on this. Slowly the markets lose interest in these topics despite the humanitarian issues because we see that it's not affecting our day-to-day life for you and I, and even for Europe and for those that are closer than we are. So the markets start to shrug it off until there's some unexpected news, either on the good side or the bad side. So for that war, unexpected good news would be an early end to the war. Unexpected bad news might be some flirting with some minor nuclear weapons or something that made it worse. But at the moment, the market assumption is this war is going to grind away for the foreseeable future. China, I've already talked about how we had some better news than expected out of China in January, which has been positive for the world. We're still not thinking that's perfect, but it's better news than it was. US politics, you're going to see a new one come into play now that the midterms are over. And in the US, the Republicans have now control of the Senate. So that means they're going to be looking to play games, as oppositions always do, regardless of which side they're on. So you'll recall about 6-7 years ago under Obama, when the same situation applied, the US has a debt ceiling where they legislate the amount that government debt can go up by. Now, it's kind of silly because government debt has to keep going up just to pay the bills of the public service and all the government programs. And what happened in that stage was the government of the day would present a bill to increase that debt ceiling so they could pay the public servants and everyone else. The Republicans would block it, they'd argue, the markets would panic, but eventually they would pass it. We expect we're going to see some of that in this year. So warning up, you're going to see some volatility in the US that comes from that argy-bargy, but it's highly unlikely that would ever turn into something long-term sustainable. It's not good for either side of politics to not pay public servants. So we don't see that run. We don't see the likelihood of that running for a long time. But we'll firstly start to look at the 24 election and when that may bring in policies that are more radical one way or the other. The market likes stable. They don't like ultra left or ultra right policies that might lead to volatility. So watch that space for either good news or bad news that will affect markets. And then I've got a couple there which I've talked about: extremism, the fact that extremes on any topic these days tend to dominate debates while the majority in the middle don't get heard as much. Hopefully we'll see that reduced, but I'm not confident of that. The catastrophization, not sure that's a word, but the fact that we want to make everything the worst ever all the time on a flood, the worst, not just floods, but any natural disaster, anything wants to be the worst since, and they'll go back since, the worst in 10 years, or the worst in 20 years, or the worst in 30 years. Now, people want to know that, but it's part of the media's drive to make everything sound like it's the worst times ever when it's not actually the case. And then we have these black swan, white swan events, more black swans. Black swans are where something unexpected comes up. When the Russia-Ukraine war started, that was a black swan event. There wasn't mainstream view that was going to happen until it started to happen. A white swan event would be something positive that was completely unexpected. At the moment, that might be the war all of a sudden finishing on very favorable terms. That would be a white swan event, something that's unexpected. We've talked about our wall of worry context, and we can see we're very much in the wall of worry at the moment. Our assessment, and I did say before, was just over fair value. I'm going to focus on one of the mess ups this month as well, and that's timing of the market. Everyone who's got an opinion, and that's all of us, we almost think we can time markets. We almost think markets are predictable. I can tell you from literally almost 40 years of research, markets are not that predictable. There is no one that consistently makes money by timing markets. And it's partly because to time markets, you have to make two perfect decisions. One is when to buy and one is when to sell, or sell and buy, depending on which order you're doing it. It's hard enough to make one of them correctly, let alone two. And as one great I think it was Howard Marks actually pointed out, to make money out of timing markets, you have to do, not only the buy and the sell right, but you have to be contrary to public opinion and right. And that's very hard to do. So if you think something's going to happen, but everyone else thinks it's going to happen, then that's already in the price. So trading on that will not make any money. So timing, almost impossible to do. We're seeing this at the moment where we get this good news, bad news. Very dangerous to be trying to time markets at the moment. We're happy for new clients to be drip feeding into the market and taking advantage of dips to buy in. But for clients that are well established in the market, it's a good time to sit tight. It's a good time as markets run up to top up the reserves or pull any money out that's needed for upgrade of cars, or big holidays and things like that, but not a time to be selling for any timing reasons, only for building up those reserves. And once we know, assuming we do eventually, which we certainly believe we will, once we know that inflation is done and dusted, at least for this little interim period, markets may surge a whole lot more. So at some point we will break out. That bottom chart there is there to show us that the natural gravity of investing, and the dark blue line there, it's up. Markets go up in the long run. We have these periods of doubt and fear, but it's not the norm. In the long run, markets will go up. I'm going to skip through some of that. I'll get through. So Aussie shares, as I said, these numbers at December, minus 3.8%. And you can see, if you can see my cursor now, the end of the year was almost the worst bit of this current V. And now we've gone straight back up past the December highs, past the highs of August, we're past the highs of June, and we're now pushing towards the all-time highs of last April, with those all-time highs being a long time coming. The Aussie share market's delivered a good, steady, 8.5% return over the last 10 years. And that's seen, we can see here the value of index investing. The index in this case, has delivered us good, consistent returns. $10,000 grown to $27,000 over that 10 years. US shares better, so but worse in the month we just had, down by 7%, down by 13.6% for the year. But brilliant over 10 years at 17%. A third of that gain over that 10 years came from the Aussie dollar falling during that period. So otherwise, US shares in US share terms were also about 10%. Phenomenal gains over the last 10 years, about 50,000. We're very much aware of impact Aussie dollar US dollar can have on that long term, and we have strategies in place that hopefully will enhance that over the next little while. US small caps, finishing the year at down 10% as well. So not a great year for them, but they look pretty good value at the moment. And once the economy starts to run, these will return. They were also very great performers over 5 and 10 years, and solid over 3, and recovering in January, not by as much as Aussie shares. I'll just go back a couple. Aussie shares have recovered way more dramatically than US shares during the last month, during January. It's a sign, it's a vote of confidence from the local market that our economy actually looks better than most world economies because we've got a lot less debt, government debt in particular. And two, that the US has probably been propped up a bit. They have more debt. And that, there's a chance if the Aussie dollar, when the Aussie dollar is attractive, it attracts overseas investors at the higher rate as well. So the Aussie market looking fairly solid at the moment. And we go to emerging markets. Emerging markets down also for the month of December, 4%, down 15% for the year. We really do think they're cheap, and emerging markets have recovered quite strongly in January, as you can see at the end of that chart. Not quite as strong as Aussie shares, but if China continues to play nice, emerging markets should have a very prosperous time at some point ahead. Gold's been the surprise, up quite well for the year, up for the month, 2.39%, up 6.5% for the year. And it's had a little run in the last month, even as we start to think inflation going down. Part of this is just a response of gold as an alternate currency. Part of it is potentially the fall of the Bitcoin and crypto assets. So people that are looking for traditional hedges against currency. Some of them started to use those cryptocurrencies. Potentially they're back in more traditional gold. We'll see where that cycle goes. We just think gold's a critical part of the portfolio. The property market, and I do like this model that we have that shows over the long run, property prices going up. In the short run, very boring for long periods of time, followed by surges and very boring. And we use the property clock analogy. But if we look at one of the factors that very much affects property prices, a positive one when it's going up, and some news out just a week and a bit ago, Friday the 13th, Australia on track for 2023 migration boom. as a rivals dwarf Treasury forecast. So we're looking like 300,000 people this year. Now, to put that in perspective, I've thrown in a chart in the right-hand corner here, which shows immigration levels, how they've grown since 1861. So we were in a zone of about 200 to 250 of net migration in the lead up, in that 2000s effectively. COVID, it dropped dramatically. It's coming back, and it's now predicted there'll be 300,000 people. Now that's good for a number of reasons. One, there's massive job shortages in many areas in Australia. So this helps relieve those without putting pressure on inflation, and particularly wages. It also will provide some demand for property. It's good news, bad news on the property front. We're going to have a property shortage. I believe this, combined with high rental yields and low rental vacancies, will keep property prices fairly stable, despite them coming down a little bit. And I'll talk about that in a minute, but this definitely provides a floor. You'll see in the last 3 months to the end of December, probably uniformly down around Australia, with some slight exceptions of regional Western Australia and regional South Australia. And we mentioned before, we're very comfortable in those areas for people buying investment properties, and that's shown up in those numbers. Minus 3.3%. To put it in perspective, you can see here the last 12 months, top left-hand corner, property prices down 5% around Australia. Sydney, so there's exceptions to that as well. Regional South Australia up 17%, Adelaide up 10%, regional Western Australia up 5%, Perth up 3.6%, Darwin up 4.38%. So be careful when people say the property market's down. Ask them which market, because there are differences, although there is a national softening at the moment. And that's completely predictable when you think about interest rates. And you see down the bottom here, the median value of properties around the capital cities, Sydney at 1 million, Melbourne at 750, etc. We're still very comfortable, very wary. So wary is the wrong word. Property will remain the potential to be really good investments for Australians who have a long-term outlook and who can afford to hold for that long term. And for those that are looking at the moment, we're still comfortable around Perth. It's about Adelaide and Brisbane. But if you hold long enough, pretty much anywhere in Australia will eventually pay off, but there's still going to be pressure wherever mortgages are higher at the moment. The chart on the right shows increase in rents. So rents up 10% across the board, and higher in places like Brisbane, up 13%. That's over the last 12 months. And you can see this little chart down the bottom shows since 2012, the increase in property prices for most cities, except for, surprise, surprise, Perth, still where it was back then. Part of the reason we think there's an uptick there, possibility there. But yeah, it's getting harder to get good long-term data. One of the ABS, Australian Bureau of Statistics series that I used to use a lot is no longer being updated. So we're looking to replace that with something else, because it's very good to look at long-term perspectives, I believe, but always opportunity, but be very careful. And the part of the story at the moment is borrowing costs, which brings us on to where rates are. We can see on the left-hand side where variable rates have gone, driven by the cash rate, which is the bottom dark blue line. And we were in emergency levels, as we talked about. As we've come out of those, mortgage rates have jumped up. It should have been no surprise, but it caught everyone, including the governor of the Reserve Bank, by surprise. So it's hit us earlier, except for those people that fixed rates, and they're still sitting at rates around 2%. They will hit that cliff when those rates start to come off, and they'll be fixing, or seeing variable rates around that 5s, 5.5. If you chase the discounts, high 4s. But if we think there's still another 0.25%, then we can call mortgages 5% if you do your work, 6% if you don't do your work with the banks, and it's worth doing the work. The work is just checking what your rates are and making sure you renegotiate or refinance regularly to keep the banks honest, because otherwise they'll let you slip up to the top of that range. So all of a sudden, mortgages 5 to 6. At some point in the next 18 months, we should actually see that drop, because traditionally when they try and slow inflation with monetary policy, it will go too far. There'll be a slowdown, and then they'll drop rates to try and find an equilibrium level. So in the long run, rates we can see a world where inflation settles eventually. Cash gets you 3 to 4%, government bonds similar to a bit more, and mortgages in that 4 to 5% range. But whether there's any pain before that normality and how long normal lasts is always questionable in the markets. We could go lower, could go higher, but we will see. Property clock. So we can see here from our friends at Performance Property, who we use to help clients find property around the country where they see value, particularly those blue chip areas, Perth, best value. But then as you drop down to in AAA, they just mean high quality capital city, and that's where triple B, you start to get to some of the regional stuff. But there's still opportunity, but you can certainly see Sydney, Melbourne, other places like the Sunshine Coast, kind of the top of the cycle. And for those that are prone to taking profits for their planning regions, it's not a bad time. Harrington White, just checking on them. Once again, they've got rising markets still predominantly around regional Queensland, regional South Australia, regional WA, Perth, Darwin still show rising, potentially a rising peak, and most of the rest on the declining markets at the moment or sitting at their peak. I threw in this month just the office clock because it does show that Harrington White, you've got some markets that have hit the bottom. Doesn't mean they're going to rise. Hobart, Toowoomba, etc. Some that are starting their recovery. So this is where they're seeing rises. Areas like Melbourne, Illawarra, Canberra, and areas that are rising. Office or commercial property should be treated very carefully. For experienced investors only, and for a small part of portfolio, we do access that through some funds. But interesting just to show how important diversification is. As I wrap up, as always, I think this year and last year shows that it's never more important to have your investing done as part of a real plan, so that you can be more confident about holding on for the long-term goals first. And that's where we spend most of our time when we're talking to you about what's happening in your world, what it's going to cost, and that helps us plan the structure of the portfolio, literally designed to meet your goals. We take a long-term view. All the boring stuff then, diversification, asset allocation, liquidity, low-cost index for most of those markets, and protect against volatility through reserves. Once again, those reserves during this downturn have proved invaluable. We've been busy topping up reserves for most of our clients that were short when markets hit 7,400. So that's very important. That's one of the things that happens where we've agreed with you in a review to do that if the market hits a certain level. And literally we were back for a week at the start of January, markets hit 7,400, and we were busy for those we'd agreed with that topping up. So that provides the buffers, more buffers going forward. We rebalance them regularly. And as always, only 3 ways to lose money and not to do them: panic and sell, have to sell, and not properly diversified. That brings me to a conclusion for this month. I hope you're having a great January. It's certainly hot up here in the Sunshine Coast. I look forward to talking to you this year. I think we're going to have a reasonable year. I can't say that for sure, but I think we've come from such pessimism, such crisis, that I think as the news gets less bad, there's a risk we have a reasonable year, and hopefully not too crazy, but just a nice year would be good. I can never lock that in. All those predictions are always hard to see what happens because the world's a dynamic and changing place. But anyway, I wish you all the best for this month. Talk again soon.